There are 7 key steps to consider for a stock idea when you're an investor at a hedge fund like Citadel and Millennium. I worked at one of these funds and we'll use Meta as an example to go through each of the steps and explain what they mean. One common trade in 2023 among these multi-manager hedge funds was long Meta, after the stock was down 70% from its all-time highs. It was actually a pair trade, long Meta, short Snap, but for simplicity we'll focus on the long side. As you can see in the chart, at the time, the stock was rapidly declining, mainly because of an overinvestment in the metaverse. And that was clearly the reason why the stock was underperforming so much. In addition to some ad revenue declines after Apple's app tracking transparency changes took place. The market was pricing Meta as if it would remain a high-spending, low-margin company indefinitely. Let's now turn into an analyst that was pitching the stock at the time. Our thesis could be something like this. We should be long Meta because the buy side is massively overstating the impact of high metaverse capex and Apple's ATT privacy changes, ignoring the early signs that the company is actively working on fixing both. Cost-cutting and AI-driven ad recovery are likely to drive operating margin expansion. This is a succinct thesis. It becomes crystal clear why you're long Meta. You should lead with the conclusion and clearly state your thesis without overcomplicating anything. Focus on your qualitative argument. You can get into the numbers later. Now, when it comes down to evidence, you want to include why you believe your thesis of operating margin expansion is likely to play out. What work have you done? What evidence do you have? This could be something like management commentary. For example, if we look at Mark Zuckerberg's subtle comments during the Q3 2022 earnings I just referred to on October the 26th, we can see that he indicated a shift in strategy. We're making significant changes across the board to operate more efficiently. Some teams will grow meaningfully, but most other teams will stay flat or shrink over the next year. In 2023, we're going to focus our investments on a small number of high priority growth areas. The comments went somewhat unnoticed, as the market didn't react positively to the call, but there was a clear shift in tone. Despite the comments, the stock dropped 25% after the earnings call, because the market still focused on weak ad growth and high metaverse spending. A key component of your evidence will be data. Because remember, the buy-side mantra is we can always put a number on anything. So your data evidence can be something like, most recent alternative data suggests that ad pricing has been stabilizing in the past few weeks of December. This indicates that Meta's AI-driven ad targeting is starting to work. It can potentially offset ATT's impact. Post Apple's ATT, advertisers pulled back their ad spending due to weaker targeting. So Meta CPM, which means cost per thousand impressions, were declining. But now we're seeing a slowdown in decline. So this is concrete data that you're seeing in the real world that supports your thesis of operating margin expansion. Another useful data point could be something like job listings data on Meta's career page dropped more than 30% from September to December, which indicates slowdown in hiring and also supports this more general thesis of the company trying to operate more efficiently, which we saw in management commentary. Another supporting evidence for your thesis could be channel checks you've done. So your argument would be something like, channel checks show advertisers are seeing better performance, indicating that Meta is getting more efficient at serving ads due to AI-driven optimization of ad placements. Meta also seems to be increasing ad load on Instagram and Reels, which means more ads per user session. We also see engagement on Reels is up, which gives Meta a growing ad surface to monetize. Even if CPMs were flat, more ad impressions would translate into revenue growth. So this is starting to show that even though the market is concerned about the slowdown in ad revenue for Meta, we have been collecting evidence that AI-driven optimization can help ad revenue. And then you can have a bunch of other supporting evidence, like Zuckerberg, the CEO of the company, sold less stock in 2022 versus earlier in the year. And this usually suggests that the management is seeing a better business outlook ahead. OPEX and CAPEX cuts is something that the company can resolve quickly if they wanted to. You could tell that Zuckerberg started feeling the pressure during the Q4 call. In fact, in October 2022, Brad Gerstner of Altimeter Capital, whose fund owns, I think, a few $100 million of Meta, published an open letter demanding 3 things: that Meta reduces headcount expense by 2%, that Meta cuts metaverse capex from 10 billion plus to 5 billion, and that Meta refocuses on AI and core ad business. The letter has now gained significant traction. So you can see now how we've presented evidence that clearly addresses the concerns of the market and directly supports our thesis of operating margin expansion. Remember, the concerns of the market were overinvestment in the metaverse and revenue declines after Apple's app tracking changes. So to truly formulate our view and evaluate the stock idea, we need to look at market expectations. And this means looking at buy-side consensus, not sell-side consensus, but the consensus among true market participants who buy and sell the stocks, because this is usually what matters. And in reality, sell-side consensus tends to differ from buy-side consensus. Bogeys is a term that's used in the industry and contains buy-side consensus and more. The narrative of what needs to happen for the stock to meet or exceed buy-side expectations. In other words, it's the collective set of conditions that buy-side investors believe the company must surpass for the stock to justify a positive reaction. In our case, we might say something like the following. Most of the buy side still thinks that Meta spending is out of control. Most don't believe Meta could execute a meaningful cost-cutting program fast enough and aren't convinced that AI-driven ad improvements can help. Then you can get into the specific KPIs and what the buy side expects for those. For example, in our case, for the full 2023 year, the buy side seems to be at 34 to 37 billion capex, 25 to 28% operating margins, and ad revenue growth of 3 to 5% year over year. Then, as part of our thesis that we should be long Meta, we should look at the specific numbers and valuation and how our evidence backs into those numbers. So, for example, I'm modeling Meta's revenue growth to 7 to 9% year over year, above the buy side at 3 to 5%. On much stronger and faster ad business recovery than anticipated. Remember, we gave evidence for why we think the current data support this. The current operating margins at 25 to 28% assume no recovery, but I expect stabilization back to pre-ATT levels of 30% plus, driven by cost cuts and ad revenue recovery. Meta is trading on 14 to 15 times forward P multiple versus historically at 20 to 25 times, and at 8 times EV EBITDA versus historically at 12 to 15 times. So now, based on our evidence, which we feed into the numbers and the valuation, Meta is too cheap relative to its long-term potential, and I expect multiple re-rating back to historical levels. We're not done yet. One of the key components of a thesis when you work at a multi-manager is to have a catalyst. You should think of a catalyst as an event or a series of events that lead to the realization of your view. Because currently, the market does not align with your view. But what is the event that's going to lead the market participants to change their perception so that they agree with you? Because if buyers and sellers of your stock never arrive at your view, you'll never get paid. For example, the biggest catalyst for technology stocks is usually earnings. Other popular catalysts include conferences, investor and analyst days, product launches, incremental data point releases by third-party providers, and so on. So we need to define our path to getting paid for our idea. So in our case, we're in December 2022, and we can say something like the cleanest catalyst for our idea is the upcoming Q4 2022 earnings on February the 1st, 2023. We can also add an extra catalyst or define a broader series of events. It could also be something like this. A secondary catalyst is likely in Q1, Q2 of 2023, when ad recovery can be confirmed by the company or further reiterated. If cost cuts are announced, OPEX or CAPEX, or the numbers support ad revenue recovery even further, which is ad pricing and volume stabilizing, operating margin expansion, which is the core of our thesis, is inevitable, and the stock is likely to be immediately re-rated to at least 20 times PE multiple. So our mini conclusion based on our evidence and analysis so far is that now the stock is priced for perfection, and earnings is the perfect near-term catalyst. Thinking about the risks and the risk-reward of our idea, the biggest fundamental risk to going long Meta in this case is whether the ad business is structurally broken due to Apple's ATT privacy changes, but we're seeing the data is starting to show otherwise. You can say something like the following. I'm less worried about CapEx spend, as this is something the company has greater control over. We saw all the pressure from management during the earnings call. We also saw the open letter by Gerstner, and so on. So our argument can be something like the following. Overall, I see an upside to the stock price of 50 to 100% and a 10 to 20% downside, with the probability of the former, which is an upside of 50 to 100%, being much greater given the current valuation of the stock. We gave all the numbers in the valuation a few minutes ago, and all the arguments and evidence we laid out. All we know, it's a good risk reward. We have an upside, which is rather large, and we also have a downside. But if we were to quantify the probabilities of the upside and the downside, based on the arguments that we provided, we think that the upside, which is more significant in terms of magnitude, is a lot more likely to take place. This is only one way to think about risk and reward, but that leads us to believe that being long Meta has good risk reward dynamics in our case. An important note here is that at the time, it wasn't obvious at all that the ad business hadn't permanently gotten worse. In fact, a lot of people thought that there might be structural permanent issues with the ad business of Meta. The data was only starting to turn positive. But part of the multi-manager game is to figure out certain things earlier than other people. Because if you wait too long, the alpha potential can decay. So as long as you start having some evidence and a decent amount of conviction that things might start changing or that we're about to see an inflection, then you should probably pull the trigger and have a position. Because as you see at the end of this video, after our catalyst, which is Q4 2022 earnings for Meta on February the 1st, 2023, sentiment shifted extremely quickly and long Meta became a crowded long. And finally, something that does matter a great deal about your thesis, as well as the risk reward of the trade, is sentiment and positioning. There is a lot you can look at to gauge and measure sentiment and positioning. Sell-side ratings, shareholder base or ownership, who owns the stock, short interest, and so on. In our case, for positioning and sentiment, we can say something like, stock is now 70% down from its all-time high, and sentiment is as negative as it could get. The buy side is still net short, though there's still few relatively large long-only owners. The sell side is mostly neutral to bearish. However, and this is important, a few analysts started turning positive in the past few weeks. That being said, the broader sentiment will still be skeptical and cautious before next quarter's earnings in February. And finally, something that has nothing to do with the quality of the idea. The reality is you might have the best stock idea out there that's just gonna kill it and 4x or 5x over the next 12 months. It might still not make it into the book. In the multi-manager world, sometimes you might have an amazing idea, but the PM might not put it into the book simply because it doesn't fit the entire construct of the portfolio and the risk limits imposed by senior management. This is a topic for another day, but hedge funds like Citadel, Millennium, Valuation are factor neutral, which simply said just means that you want your portfolio or a set of stocks to not be exposed to any factors but the one you're betting on. So in our case, we have a view on Meta's operating margins. If we were to make or lose money on that bet, in theory, it should only be because we either got the operating margin bit right or we got it wrong. But we don't want to lose money on other unhedged factors. Senior analysts at these funds tend to be very aware of the factor exposures of the book and incorporate this awareness in their pitches to the PM. For example, in our case, a senior analyst might say something like, we're overexposed to the digital/retail ad factor, and long Meta would be a beautiful hedge to our short positions in Google and Amazon. And because these funds try to be beta neutral, their trades tend to be very common. Because if you go long one stock and short another stock with similar characteristics, it allows you to hedge those characteristics, except for that one stock specific thing, in our case, Meta's operating margin that we're betting on. In our example, at the time, Snapchat was experiencing many headwinds, and many PMs likely had long Meta, short Snap, or short Snapchat as a pair trade in their book. Finally, in an ideal world, one would also address the sizing of the position, which is directly linked to conviction, even though there are so many different ways that different PMs size their position. Some of them use software, some of them do it more on an intuition basis, others rely on their conviction levels. In our case, it could be something like, we should start small and size up accordingly as market sentiment starts shifting, heading into and post earnings. And we should also continue to track ad pricing trends to confirm stabilization of the core ad business. which is just next steps or some of the things we should monitor to manage our position. So you may be asking, what happened with Meta? In Q4 2022 earnings, which is our catalyst, the CEO announced the year of efficiency, cutting capex, laid off 11,000 plus employees, and emphasized profitability. The stock jumped 20% overnight. By Q1, Q2 of the same year, 2023, AI-driven ad targeting improved significantly. So ad revenue started recovering, AI-driven ad targeting improved, which supported ad revenue recovery and expanding operating margins faster than expected. So the market re-rated Meta from 14 times to 20 times PE, which drove the stock price from $120 to $300 by the middle of 2023. So what about Meta today? The stock is now obviously in a completely different position. It's a very heavy consensus long, as most investors think that it will be the biggest AI beneficiary. As investors think it will be one of the biggest AI beneficiaries. It has further solidified its position of a favorite long, given the current cheaper compute narrative. You can potentially still make a case for a short in the short term, as the market seems to have been pricing a TikTok ban that might result in a deal instead. A tough one, but it's a possibility. So the structure of the steps that we provided is arbitrary, but the concepts hold true in all cases. Remember, in the multi-manager world, you want a differentiated and meaningful view supported by evidence with a well-defined catalyst, good risk-reward, favorable setup, and factor exposures that fit the construct of the book.